In this video, Mohamed El-Erian analyzes the current stock market dynamics, attributing recent volatility to profit-taking and rebalancing rather than signaling economic caution for 2025. He believes the U.S. economy can manage rising treasury yields due to strong growth compared to other regions, but he remains cautious about persistent inflation and potential missteps by the Federal Reserve.
Can the real economy handle it? I mean, that's what stocks care about. What's your read on that element of the market action?
I think the real economy can handle it because rates are going up for one good reason and a couple of less good reasons. The good reason is growth. U.S. continues to outpace the rest of the world. You see that in the rate differential in 10 years between the U.S. and Germany. That's now 220 basis points. That's quite high. There are two issues. I think inflation is more sticky, and the Fed is going to tolerate more sticky inflation. And also there's a concern about issuance. But on balance, the economy will be able to handle this if we don't get a policy mistake.
And what would a policy mistake represent right now? You know, I think a lot of folks were looking for evidence that might be one of the market's concerns after the Fed really did reduce its anticipated rate cuts for 2025. But you wouldn't necessarily expect to see longer-term yields going up if we were pricing in a potential policy mistake that would bring on recession.
Yeah, and I think the rate behavior has a lot also to do with the notion that inflation may be sticky. I cannot stress how important it is for policy not to undermine U.S. economic exceptionalism. That has acted as a shield for U.S. markets, for the U.S. economy, from a lot of headwinds coming from the rest of the world. Europe is essentially in recession. China cannot balance its reforms with its stimulus. Geopolitics has gotten more complicated. So we've had this incredible shield for the economy, for the markets of this exceptional economic performance. And we need to maintain that. And this is where the policy issue comes in a big way, Mike.
What policies are you really discussing there aside from what the Fed does? I mean, are we talking about what happens under the next Trump administration, whether it's, you know, taxes and tariffs, or do you mostly mean monetary policy?
So at first, I mean monetary policy. It's important for the Fed not to be overly restrictive, and that means it will need to tolerate a slightly higher inflation rate because there's so many structural changes. And then for the incoming administration, there's going to be a race. On the one hand, you have deregulation, you have liberalization, which is going to get turbocharged by a lot of corporate activity and by what I think are significant productivity promises associated with AI and with life sciences. And on the other side of that race is the risk of excessive tariffs and the risk of undermining the labor market. So a lot will depend on this race, and the hope for the markets and the hope for not just the U.S. economy, but the global economy is that race is going to be won by what are pro-productivity, pro-growth measures.